Pleasant good afternoon to all our members. Welcome to this evening's webinar entitled Financing Your Home Ownership with CECU. My name is Asha Baksh, and I'm the Finance Manager of Canning's Employees Credit Union. It is my distinct pleasure to be the moderator for this evening's session. Today's webinar is focused on educating our members on CECU's mortgage process and providing guidance on how you can acquire your dream home. Before I introduce our presenter, please allow me to share our house rules. Firstly, please know that all mics will be muted throughout the presentation. And at the end of the presentation, we will have a Q&A session whereby you can ask your questions. During the Q&A segment, if you have a question, please click the raise your hand button and your mic will be unmuted for you to speak. Alternatively, throughout the presentation, if you have a question, you can type it in the chat and we will address it at the end during the Q&A session. Today's seminar is expected to run for approximately 1.5 hours. This seminar will also be recorded and the recording will be uploaded in the library section on CECU's website along with the presentation. I take great pleasure in welcoming our presenter, Mrs. Kelly Trabuley-Hack, who is the General Manager at Canning's Employees Credit Union. Mrs. Trabuley-Hack has over 20 years' experience in the financial services and property development sectors. She joined CECU as the Finance Manager in September 2013 and subsequently assumed the position of General Manager in 2017. Kelly serves as the ex officio on the Board of Directors and all committees, and her experience includes key areas such as finance, marketing, and credit. Kelly possesses a master's in business administration from the Heriot-Watt University and is also a member of both accounting bodies, ICAT and ACCA. So a very special welcome to you, Kelly. At this point, I now hand over to you.
Good evening. Thank you very much for the introduction, Asha, and a warm welcome to all our members who have logged on today. This evening's webinar is entitled Financing Your Home Ownership with CECU. And what we'll be covering today, we're going to be looking at everything from the planning stage all the way through to taking the mortgage application, and everything in between. As Asha indicated, all the material and the recording today will be loaded to our website so that they will be there for reference later on. My presentation is expected to last about 35 minutes or so, after which there is going to be a Q&A session. So throughout the presentation, jot down your questions. You can even put your questions in the chat box during the presentation so that they can be addressed during the Q&A session. So let's get started. The topic, that we're going to be looking at today, really, it's 5 areas in particular. We will be looking at the area of planning. We're going to touch a bit on budgeting, a little bit on the property search, and we're going to spend some time looking at the mortgage process, looking at our mortgage product here at CECU, and showing you a few mortgage scenarios, and going through that very important checklist of documents that's required for your mortgage application. So let's talk a little bit about the planning aspect. When one thinks about purchasing property, whether it's for your dream home, you want to purchase your dream home, or for investment purposes, it's really a life-changing decision. It is probably the biggest investment that you will make in your lifetime. And because of that, a lot of time and planning has to go into it. And generally, what we see is that individuals, they start thinking about home ownership maybe around their mid-30s. 20s is you're now starting your career, you're enjoying your life, you're traveling, you're living it up a bit. And then when you hit your 30s and you're approaching your mid 30s, things are a bit more, you're settled in your career, you've started to save, and you start thinking about those bigger decisions like home ownership. So it's really not until early 30s, and we see anywhere from early 30s all the way to 45 and later, you have individuals thinking about home ownership. And when you start to think about it, it can be a bit daunting. The process itself it isn't a short process. This is not like buying a car. When you're in it for the long haul. Mortgages can go all the way up to 25, 30 years. So it can be a bit daunting. And one of the areas that's specifically daunting is the down payment. So generally, when you're purchasing property, and it's a standard percentage in probably almost all sale agreements, is that when you're purchasing property, you have to pay the vendor, the seller, 10%. 10% of the purchase price. So if it's a property for 1.5 million, you've got to pay the vendor $150,000 down, and that is signing the sale agreement and saying, yes, I'm going to be taking the property. This is my commitment. I'm handing over this check to you. And that down payment, it's not a small amount. That 150,000 or how much ever it is a large amount. So the thought of having to have that available sometimes is quite daunting. And there are different scenarios really with down payments, and people fall into different groups. Some persons would already have the down payment in place, and some would have to accumulate along the way. So you would have situations where individuals may have maybe an inheritance. Money has been willed to them. You may have circumstances or situations where you've got married and family and friends have gifted. It's monetary gifts, so it's accumulated to basically a down payment of a home. You have scenarios where parents they have the savings and they want to assist their children. Their children want to buy their first home, and parents want to assist with the down payment. You also have scenarios where individuals have other assets and they choose to liquidate some of those assets to be able to pay the 10% down payment. And the most common one is generally accumulating your savings over time to make up this down payment. So individuals based on circumstances could fall into any one of these. But we're going to spend a little time focusing on the accumulation of the savings over time. And this is specifically for a down payment. So the next slide really looks at the planning. As I said, we don't wake up today and decide tomorrow we're going to go take a mortgage. Planning is involved, whether it is the planning to accumulate the down payment and then apply for the mortgage, or you already have the down payment and you've started your property search to be able to then go to a mortgage. Planning is the key thing. And we're going to look a little bit at the accumulation of the down payment. So if you don't have, a nest egg or savings put aside, on average, let me backtrack a little bit there. On average, you find property prices being anywhere from $1 million and up. So you're looking at 10% of that. So you're looking at about $100,000 and up when you're looking at a down payment that you need to have. If you're saving towards the down payment, you need to set a timeline. If you don't set the timeline, then you don't have a goal to work towards, and you find that it may sometimes fall off the radar. So set a timeline, and you're setting a timeline for two specific things. You're setting a timeline by which you've accumulated your down payment, and you're also setting a timeline for what is the oldest age that you want to be able to take that mortgage. And in figuring that out, you need to ask yourself a few questions. So you need to ask yourself, what is the retirement age where you currently work? Is it 60? Is it 65? Nationally, it's still 60. I know there is a lot of talk and discussion taking place with stakeholders regarding moving our retirement age to age 65, but it's still 60. But in some companies, retirement age is 65. And that's important because up until retirement, you would be earning your salary. So a certain amount will be coming into you every single month. When you hit retirement, that changes. And your income is no longer that salary that you would have grown accustomed to. Your income now becomes dependent on pension and NIS together and those benefits. So that's why we only go up to retirement age, because after that, you don't want to have to be still financing a mortgage. You need to figure out what's the latest age you want to apply for that mortgage. Is it age 30? Is it 35, 40, 50? What's the latest age that you want to apply for the mortgage? And you need to figure that out, because if retirement age is age 60 or 65, so let's use 60, and the latest age that you want to apply for the mortgage is age 45, it means that you only have 15 years to pay off that mortgage. So the longer you wait, the shorter the time period to actually pay off your mortgage. And of course, you have to ask yourself, what is your age now? And from those questions, you're able to determine how long do you have to be able to save up your down payment. Now, I know the question might be, well, how am I supposed to know how much I'm saving? And you can actually go to our website and play around with our mortgage calculator. What you have to do is you're working backwards a little bit. So rule of thumb is a mortgage installment should not be more than 45 to 50% of the gross household income, and 50% being the really max. We try not to even go all the way to 50%. So if you could be at 45 or even 48, great. But 50% being really the maximum. And that's what calculates your debt service ratio. So you can play around with our mortgage calculator. In this presentation today, you're going to see what our interest rates are. So you'll have that information. So you put in the interest rate and you already know what's the latest age you want to take this mortgage and how many years you're going to have to pay it. So if you're taking a mortgage at age 45 and retirement is 60, you know you have 15 years to play with. And you can actually play with that mortgage calculator to see what installment would represent about 45 to 48% of your gross household income. And you're going to be able to see how much you qualify for in a mortgage based on your debt service ratio. So I encourage you, because I have members that actually would book a consultation just for that aspect. And that's something you can actually play around with on the mortgage calculator to figure out, based on your current circumstances, how much you might be able to qualify for. Again, that's simply based on that service ratio. There are other things that have to be considered, because that's going to help you figure out. So let's say your salary, your household income is 18,000 a month. 45% of that is about 8,100. Assuming you are taking a 20-year mortgage, then the installment is under 8,000. It means that you can qualify based on that service ratio for about 1.2 to 1.4 million. So it means that in terms of having a down payment, you're looking at saving up to 120, between 120 to $140,000. So that gives you an idea of how much you have to work towards in terms of saving for the down payment. And it also gives you an idea of how much you might have to be paying in an installment, as well as the time period. So when we look at the next slide, because we've kind of figured out, okay, how many years I have to accumulate my savings, I kind of figured out what's the estimate I have to be saving towards in terms of a 10% down payment. I'll say it again, that this is one of the biggest decisions that you'll make in your life, and saving towards the down payment and even repaying your mortgage, it takes a lot of discipline and it takes a lot of commitment. And one of the most important things that you have to do is budget. It is the key. And this is a very simple, this little chart here, just a little Excel chart. It's a very simple way to figure out how much you can afford to save every month. And notice I underline the word realistic here because we can say, okay, I'm going to save $5,000 every month, but it may not be a realistic figure. And then what happens is you take out the 5,000 and you put it in savings. And then you realize that, okay, no, I need to take some money from that, and then you're taking it out. So you don't want to be in a position where you're putting the savings in and having to touch it all the time. So when you look at this little chart, what it does is it takes the household income and you deduct from it your statutory expenses, meaning the ones that come out automatically from your salary. So tax and NIS and health surcharge, pension contributions, those sorts of things. And then you take out your regular monthly living expenses. So if you're paying rent, if you have loans and credit card monthly payments, if your utilities, food, transportation, motor vehicle expenses, things like that. Whatever is left in the income after the expenses, that's where you can get available savings. So based on what that figure is, that will help you determine how much you can realistically afford to save each month. The next scenario, we're looking here at a few planning scenarios, savings plan scenarios, I should say. And we're using 3 different ages at which you're looking to take a mortgage. And we're going to use the value of 1.2 million. So you're applying, and this is focused more on how you're accumulating your down payment. So applying for 1.2 million, it means that you need to have $120,000 saved for your down payment. If you don't, and let's assume you haven't started saving for the down payment, you're now going to start. So you're age 30 and you've decided by age 40, I want to be able to take this mortgage. It means you have 10 years to save. And of course, assuming that your salary is within the required amount, you have 10 years to save. To accumulate that 120, you really need to save 12,000 a year. If you break that down monthly, it's $1,000 a month. If you're 40 years old and you decide by age 48, I'm taking that mortgage, same 120,000, you have less time to save. So you have about 8 years. It means that you need to save about $1,250 a month because you have to accumulate 15,000 a year. And then let's say you're age 45 and you say, okay, that's it. By 50, I'm going to own my home. That is the year I'm going to apply for my mortgage. You just have 5 years to save your down payment. And that means that your monthly saving requirement is about $2,000 a month. So what this shows is that the longer you wait, the more you're going to have to save each month to accumulate your down payment. Now, some little pointers with the saving. Set up a salary deduction or direct debit. It is easier when you figure out how much you want to save each month, it's easier for it to come automatically out of your salary than it coming to you and you having to give it back, because that's the hardest thing. When the money comes into your hand, for you to have to give it back and give it back, willingly, but like put it in savings, it is actually very hard. So do it where you're not even seeing it. It's an automatic thing. It comes out. The other thing is put it in a separate account. Don't put it in your regular savings account where your salary is coming in and you are spending money from, because it's going to get mixed up. In addition to which, you're seeing it all the time. You have to separate it, put it somewhere separate where you're not seeing it very often and it's not getting mixed up with your day-to-day operating expenses. And most importantly, place your savings monthly for this purpose, especially where your savings is going to earn a good return, because that way your savings is earning a return, which will also earn a return, and it will grow and it will help you get to that target of your down payment a lot sooner. And of course, the perfect example here is your share account right here at CECU. So your share accounts are actually supposed to be more investment type accounts. You really shouldn't be taking money in and out of your share accounts all the time, because when you do that, it affects your dividend each year. So put the money aside in your share account and let that earn dividend. Our average the average returns over the last 5 years or so, the average dividend that we've paid has been 4%. So imagine you putting that away for the next, you're saving consistently every single month for the next 5 to 10 years, depending on your age and when you want to take your mortgage, and you're earning a good return. It means you're going to get to your down payment target a lot sooner than you think. Yeah. So that's the little bit about the planning. And I can't stress enough that if you haven't started saving towards your down payment, then this is critical. And it really does require a lot of discipline, because you're not going to do it in 1 year. You may not be able to do it in 2 years. It does take a few years to accumulate your down payment, unless you are with the circumstances where you already have it, or it has been gifted to you, or something like that, right? So let's talk a little bit about the property search. Now, the property search, you don't have to wait until you have your down payment to start a property search, because you can actually be looking at properties. So you can be searching passively. So while you're accumulating your down payment, you can be looking. There's no harm in starting to look and see what is available in the market, get a sense of what the prices are. The real estate market has changed a lot in the last couple of years. We've seen during the COVID years, we saw property prices coming down. We're seeing now property prices going up a little more. You're seeing more this year, a lot of developments. So a lot of houses being constructed, a lot of gated communities and developments going up. So take your time and start to look. While you're saving up your down payment, you can be passively searching. Once you have your down payment, then you can start to really actively search and start to actually go and see properties. But when you start looking, you have to know what you're looking for. Again, it's the biggest investment that you're going to make in your life, purchasing property. And this property may be for your family and then passed on to your children, passed on to your grandchildren, maybe in your family for a long time. So you want to take the time to really figure out what it is you're looking for when you're looking for that home. And you can ask yourself a few questions. Do you want a standalone house, or do you prefer an apartment, condo, townhouse style living? Are you looking for a gated community or non-gated community? What area do you want to be living in? Is it, if it's apartment style, is it pet friendly? You might have pets that you want to move with. Is it a pet friendly area, because or compound, because not all apartment townhouse style properties allow pets? Do you want a brand new home, or do you want to look for something that is a little more affordable, but it's a fixer upper, and each year you can fix a little, fix a little? Which one do you prefer? This is a big one, because traffic is a big thing in Trinidad, especially. What's the commute to your place of work? How far are you willing to commute? What's the distance? How much time are you willing to spend in traffic every day? Those kinds of things. And another one that is, really important, especially now when you see what's going on a lot every day, you open the papers and you see something else. The security in the neighborhood. What is it like? I remember pre-COVID when we were doing these mortgage seminars and we were doing them face to face. A realtor said in their presentation that when you're looking to buy or even rent property, take a drive by at night, because at night you're able to see how secure that neighborhood is. You're able to see how many street lights, how dismal it is, how busy it is, things like that. It gives you a sense of how safe the neighborhood may be at nighttime. So, little things like that. And then one that's not on the list here, but I think I should have put it on, is, and of course, we're not hearing too much about it right now because it's dry season, but surely when rainy season begins, we'll be hearing this flooding. So when you're looking to purchase property, you've got to consider, is this a flood prone area? Is there a risk? Because when flooding takes place, that causes damage to homes and whatnot, and then the value of your property could be compromised there. So those are things that you need to consider when you are passively searching or even actively searching. When you're actively searching, register with more than one realtor. There is no rule that says that you have to register with just one realtor. You can register with as many as you want. It's free of charge. You don't have to pay for that. It's usually the seller, when they sell property, has to pay the realtor and the buyer doesn't. So register with realtors. There's an excellent website that you can go to, mybunchofkeys.com. A lot of reputable realtors list properties on that site. And the way the site is set up, you can filter to your budget. So if there's a particular value you're looking at or value range, you can put it in. You can also put, okay, standalone houses or apartments. You can select what areas, and you can get a sense of what is out there. So that way you don't have to be calling or registering too much with realtors, because numerous realtors register on this site. If you see something you like, you can actually get in touch with the realtor. You can message them, stuff like that, and get information. When you start to actively search for properties, view as many properties as you like. You're not gonna, it's very rare when you find your dream home on, the first property you go to. Look around. Don't just rely on pictures. Go see the properties, talk to the neighbors, ask people about the properties, all of those things. And most importantly, view properties that are within your budget. We all have dream homes where we want all the fancy and pretty things, but the reality of it is that it may not be within our budget. So know what your budget is and view properties that are within your budget, that are affordable to you at this stage in time. Yeah. So once we have accumulated the down payment and we figured out where we want to purchase, we found the property that we want to purchase. The next stage is financing. How are you going to pay for this property? And this is where CECU comes in. And I would like to think that all of our members think about their credit union first when they think about financing and they come to us to ask the questions. Because at the end of the day, we do have your best interest at heart. The very, very, very first step in the mortgage process, and we make it mandatory now, is that you have to have a consultation with me. It's a free consultation. There's no cost to it, and the consultations could go anywhere from 30 minutes all the way up to an hour and more sometimes. But it is probably the most important step in the mortgage process, because in that consultation, it's not me just talking to the member about terms and conditions. It's a conversation. It's a conversation between the member and myself. And a lot of the time, the beginning of the conversation, I don't say anything. I ask the member to tell me what it is you want to do. And we get an understanding of where the member's mind is, what it is they actually want to do, what they have in mind. And then we start to discuss things like, okay, do you have the 10% deposit available? What is the salary? What's the household income? What's the age? That kind of thing. And there are times when during that consultation, I've done consultations where members have walked in and they're ready to take a mortgage. And in discussing and in the middle of the conversation, asking the different questions, talking about it, they realize, okay, maybe we need to wait a year or two because one or two aspects may not have lined up where they wanted it to be or where it should be right now. So, and then there are consultations where All the T's are crossed, all the I's are dotted, and we can move on. But the consultation really is the most important part of the process, because in that consultation, we don't just look at the terms and conditions and all of that, but we explain the process so that the member understands everything that has to take place. As I said at the beginning, the mortgage process can be a bit time consuming. An average mortgage can take 90 days to close, and there are mortgages that take 120 days to close. That's usually when the additional town and country requirements that we don't have as yet, but it's an average 90 days, so 3 months. And there's a lot of the legal stuff and a lot of documents and approvals and all these different steps that have to take place. And the average person, if you've never bought property before, you may not understand why you have to do some of these things. So in the consultation, I explain it to the member. I explain why the title search is done, why we need a valuation, why we ask for approvals, all of those things, so that when you as the member make the decision, yes, this is what I want to do, you understand fully the entire process. So the consultation is the first step, the mandatory step before any other discussion about mortgage takes place. Assuming that all is fine after the consultation and debt service ratio is fine, and you have the 10% on your shares, and the term of the mortgage is fine and everything, we go on to the next steps. Now, we do not do a mortgage application upfront because we want to make sure, and again, this is us really putting our members first here. We want to make sure that everything is in order with this property with regards to legal title as well as the value. So there are 3 things that are actually done simultaneously. The draft sale agreement, and the sale agreement really is the agreement that is put forward by the seller. It's usually prepared by the seller's attorney, and it states the terms and conditions of the sale to the person buying the property. It is a legally binding document. So the sale agreement is reviewed by an attorney. And it's important that a sale agreement is reviewed because as much as there are standard clauses, there are sale agreements that have additional clauses. And where it comes to developments, there are additional clauses on top of the regular clauses. So it's really important that an attorney reviews the sale agreement to make sure before the member signs that everything, there isn't any additional risk in that sale agreement. Because at the end of the day, when the member signs the sale agreement, they also have to hand over the check for 10% down payment. So that's why having that attorney check the sale agreement is really important. The other 2 exercises, and again, they're done simultaneously, is the title search and the valuation of the property. The title search looks at the legality. The person selling this property does have legal title, and this property, make sure this property isn't tied up in any other debt or anything like that. So that's why the title search, report on title, is called title search as well, is done. It's to make sure that the property is free and clear of all encumbrances and that the person who's selling has the authority to sell. The valuation report measures the value of the property, and that's something that is so important because when you're buying something, you don't want to put out money to buy something that it has a lower value, especially when you're looking at a mortgage. You don't want to spend a $1.5 million to realize that the value of what you bought is actually 1.3 million. In addition to which, the financial institution will not lend more than the valuation amount. So if you are looking to buy a property for 1.5, it means that valuation report has to come in at 1.5 or more. Yeah. So sale agreement, title search, and valuation, those 3 things are done simultaneously, very much to protect the member and also to protect us, because sale agreements protect you where search is concerned. So if there's an issue with the ability to sell that property, Most of the time in the sale agreement, you can get back your deposit. But where valuations are concerned, you can't get back your deposit. So if you, that we stress to members, please do the valuation before any sale agreement is signed. Because if you sign a sale agreement and then the valuation comes back, you can't change your mind and say, give me back my 10% down payment, right? Now, once all the above items are in order, meaning sale agreement, title search, valuation, and then we move forward to the application process. And one of the things that we do, so in order to apply for a mortgage at CECU, you need to have 10% of the amount that you wish to borrow here on your shares. That has to be on your shares because that forms part of the collateral. But then you also have to pay 10% to the vendor. So instead of having to come up with 20%, so again, we'll use the 1.5. If you had to put 150,000 on your shares and then pay the vendor 150,000, it meant you'd be looking for $300,000. And realistically, that's, the average person saving that amount up by the time you want to take a mortgage. Sometimes it's not possible. So what we do instead is we do a 90-day secured bridging loan against your 10% that's on your shares. So the 150,000, and again, this is based on a $1.5 million mortgage, 150,000 that's on your shares, we will grant you a 90-day bridging loan. And just to make the distinction, this, when I refer to bridging loan here, this is not the bridging loan that you hear the banks offer. That's for construction. We don't do that type of bridging. This is specifically for 90 days, bridging the down payment to the final payment. So we would do a 90-day bridging loan where we secure the 10% down payment against your shares and you get the money to pay the vendor. And that way you're not out of pocket. And we also are secured because it's secured against your shares. Once that's done, your sale agreement is signed and the 90-day clock begins. The 90-day clock meaning the closing period for the mortgage. As I said, in rare instances, it's 120 days. In 99 out of 100 times, it's a 90-day closing period. So the time clock begins from the time you sign the sale agreement. After that, it really is the mortgage application. So we would compile the mortgage application. We would ask you for all the supporting documents. Later on in this presentation, you will see the entire checklist. So it will be all the supporting documents that go with the application. And then an executive summary of your application is done and it's presented to the credit committee for consideration. Once the credit committee approves, we then seek commissioner's approval. As a credit union, once we're granting a mortgage, we must get the approval of the commissioner's office to be able to grant the mortgage. So that's done as well. And then the final stage, really, it's the legal documents and the closing and the handing over of the balance of the mortgage payment to the seller. And one thing that I didn't put in here, but it's a very important part as well, and this actually happens probably before the 90-day bridging loan, is a meeting with our chair of credit. So the first meeting takes place with me, which is the consultation, understanding what it is you want to do and guiding you through the process. And the second meeting, which takes place before the 90-day bridging loan, is with our chair of credit. And that discussion is more along the line of making sure that you have a plan B and C in place. COVID taught us a lot. And we saw during that time where, persons were laid off, they were furloughed, salaries were cut in half, all these kinds of things. And you suddenly had to figure out, how do I pay my loans? How do I pay my mortgage? How do I pay my car loan? So then now, we are kind of bringing it to the forefront of members' minds. You need to have additional savings set aside, because what if something happens? What if 2 months down the line, you can't work for 3 months? You have to be able to pay a mortgage. So it's having that conversation with the member in terms of what other savings do you have? If this happens, what's the backup plan? And starting to get the member to really think about about these things. So that also takes place. So essentially, this is what our mortgage process looks like. What we will say is that, from the get-go, we hold the hands of our members. Um, During that 90-day period, members, you can call us, email, WhatsApp numerous times, and we will guide you through the process. And we also make the process really simple. You don't have to go looking for a valuator or looking for an attorney or looking for an insurance person or anything like that. We actually have the service providers on our panel and we make it very simple for you. So it is that one-stop shop experience. And we explain everything as simply as ever to you along the entire process. So we really never let go of your hand until you get the keys to your home in your hand, and then we let go. So let's take a little look at CECU's mortgage product. So this is our mortgage product. And essentially, there are two main types of mortgages. We do, there is purchase of property. There's also purchase of land. And in terms of the requirement on the shares, if you're purchasing property, you need to have 10% of the amount that you wish to borrow on your shares, and you need to have that free and clear, meaning not assigned a loan or anything like that, free and clear. If you're purchasing land, then you're looking at about 15% that you need to have on shares. Again, free and clear, not linked to any loan or anything. Our interest rates, they're tiered interest rates. So up to $1 million, the rate is 5.5% per annum on the reducing balance. Over $1 million, but less than 2, we're looking at 5% per annum. And over 2 million, you're looking at 4.25% per annum, all on the reducing balance. And let me just correct a misconception that some people have. I mean, it's understood when you're looking at mortgages and looking at financing for mortgages, you shop around. And we're born hearing about the banks. I am certain everybody has a bank account. So it's natural. You also go to the banks and you ask and you inquire what is there. But sometimes the banks, and not sometimes, but recently the banks have been saying that credit unions calculate their interest, compound interest. That's not true. For credit unions, at least I can speak for CECU, we don't use compound interest. It's reducing balance. It's actually calculated the exact same way the banks would do it. It's an amortized loan, which is it's reducing balance, meaning every payment that you make, part of your payment goes to your principal and part to interest. And your interest is always calculated on your outstanding principal. So every month your principal gets a bit smaller. It means every month your interest gets a little smaller. So we don't do any compound interest. It is reducing balance interest, just like how the banks do it. And the next part is where I have pride in saying that they are all of 3 costs. And these are 3 costs that you would actually incur anywhere. It's the valuation fee, the legal fees, and the life insurance. The valuation fee is for your valuation report before you actually do your mortgage before you do your mortgage application, sorry. And that report really is your report. We get a copy of it. And it's important because it lets you know the value of the asset that you're going to purchase. So either which way, you should get a valuation report. So that's one fee. The legal fees, our attorney fees are actually discounted, but the legal fees will cover things like searches. If you ask our attorney to review the sale agreement, deed of mortgage, deed of conveyance, stamp duty, instruments of charge, assignment of insurance, all of those things fall under the legal fees. And when we go to the slides coming up, you'll see that the legal fees actually are not, massive amounts. And then the last item, which is a member cost, is the life insurance. And I just want to touch a little bit on the life insurance because there are institutions that have waived the life insurance requirement, but we haven't. Because the life insurance is really important. This is a mortgage is a big debt. right? It's a big debt, it's a big investment, and the investment is linked to a large debt. And the life insurance is in place so that, God forbid, anything happens to you, the insurance pays off the loan. Because we don't want to ever be in a position, and again, COVID taught us a lot. Years ago, people were living to 80, 90. COVID showed us, no, life is very precious and people were dying very young. And we don't want to ever be in a position where someone has passed away and there is a mortgage outstanding and we have to go to the family in their grief to say, we have to take you home, or how are you going to pay for this debt? And there's a large amount remaining. We don't want to ever have to be in that position. We don't want to have to put members and their families in that position. So we still keep that life insurance requirement. What we have done is that we have indicated if you have your own personal life insurance and you would like to assign it to the credit union, that can be done. It may mean that you have to increase the value of it to match the mortgage value. And it's entirely up to you, because we do recognize that life insurance will come as an additional payment every month. So you can assign your own personal life insurance for the mortgage, or if you want to take out separate life insurance or term life insurance, you can also do that. But like the life insurance requirement is a very important requirement. And this is the one that I have a lot of pride in saying, that where the administrative fees are concerned, things like processing fees, credit report fees, negotiation fees, we have none. None, zilch, zippo, nada. Negotiation fees in the bank are actually a percentage of the value of your mortgage. So imagine that. Imagine $1 million mortgage. And let's say it was, 0.5%. That's a lot of money. Or even 1%. That's a lot of money. We don't have any of those fees, right? So you're saving money from the get-go with this. So the next thing we're going to look at, the next 3 slides actually are mortgage scenarios. So we're using 3 different values, and what I'm showing you here is what a mortgage is going to look like over 3 different terms. And of course, we have some assumptions that we're making with these scenarios. So the first scenario we're going to look at is a mortgage for $1 million. Let's assume this is a first-time homeowner, meaning your name has never been on property before at all. And we're also going to assume that the member has the down payment. So they have the $100,000 requirement. And we're going to assume that the household income is $18,000. And I say household income because you can have a household, with combined income. So husband and wife, or parent and child, or something like that. So it's not always single income. So we're going to assume those things. And what we've done here is we've shown a mortgage for 25 years, 20 years, and 10 years. So what you can see here is that $1 million mortgage, 5.5% per annum, over 25 years, the installment is just under $6,200. But if you were to take this mortgage for 10 years, meaning you're taking it when you're a bit older, that installment goes up. It almost doubles. It goes up to just under $11,000. And then take note of the fees. So when I said the fees are not massive fees, valuation is approximately about 4,000. Valuations are based on the value of the property. So there is a specific formula that the evaluators use, and it's based on that formula, but it's an approximate value. And I did get the estimates from our attorneys for these figures, so they are spot on. Approximately $18,000 in legal fees, and the legal fees actually pick up everything except stamp duty. First-time homeowners, if you are purchasing property up to the value of $2 million, you're exempt from stamp duty. Stamp duty is actually the biggest figure in the legal fees. So if you're a first-time homeowner and you're looking for property, and you can go all the way up to $2 million, you don't have any stamp duty. So your legal fees are dramatically reduced there. All right. And the other thing I want to point out, remember that our debt service ratio is between 45 to 50%. And again, 50% being the real maximum, that we try not to go all the way there. If you look at the 10-year mortgage, what you realize is for a household income of $18,000, you realize the DSR would actually be more than 50%. So if your household income is 18,000 or less, you wouldn't qualify for a 10-year mortgage. Your income would have to be a few thousand more, probably about 21 or $22,000 to be able to qualify for a 10-year mortgage here, right? Another point before we change this slide, and I'm going to point it out for each of our slides, is, and this is something that I don't believe the commercial banks have, your deposit on shares, that continues to earn a return. So when you put, so in this instance, it's $100,000, it's going to be on your shares. That's going to continue to earn dividend every single year. And I mentioned it before, the last 4 to 5 years, or average dividend has been about 4%. You leave you that 100,000 or whatever your down payment is on your shares. And imagine you've taken a 25-year mortgage. At the end of 25 years, you still have your down payment, which has probably been doubled because it's earning income. It's earning the return, and dividend will earn dividend every single year. So it's a win-win situation. So if you look at the second scenario is a $1.5 million mortgage. Again, we're assuming first-time home ownership, and we are assuming a monthly household income of $22,000. And you can see again, 25, 20, 10 years. For 25 years, you're looking at about just under $8,800 a month. If you are looking at 10 years, it almost doubles. And then same thing as the last slide. If you're going for 10 years and your household income is 22,000 or less, you're not going to qualify for a 10-year mortgage. Your household income actually has to be over 30,000 to fall within the DSR range, right? Looking at the legal fees and valuations as well, you're looking at fees totaling at most 25,000. It could be less. And again, the 150,000, which is your deposit, will earn a competitive return each year, so that it's like deferred savings. When your mortgage is paid off, you have that there for you. And then the third scenario is a $2 million mortgage. This one, again, first-time home ownership, and we're assuming monthly household income of $28,000. So for 25 years, it's just under 12,000. Then we've got the 20 years. And if you look at the 10-year, again, almost doubling. So what these scenarios show is that the longer term for the mortgage, the lower installment, but the shorter time span to pay off a mortgage, the installment is much higher. And of course, legal fees are just about 25,000 averaged here. And as I said before, you're taking a mortgage up to 2 million and you're a first-time homeowner, then you are exempt from stamp duty. The next slide goes to the checklist. So it looks like a lot of items here, but really, are some of these items we ask for a regular loan as well. But this is essentially, these are the supporting documents. So when I refer to the supporting documents attached to your application, this is what the checklist looks like. Now, these are the basic items. The two items that are highlighted in yellow, they're the title search and valuation. That's stuff that we request on your behalf. So you would find our attorney would do the title search and the valuator would do the valuation. But all the other documents we would require from you, the member, or the realtor, whoever's handling the transaction for you. Now, other documents can be asked for. It depends on what comes out in the title search. So I have seen searches where the attorneys have asked for deed of rectification, or if it's registered, if the property is registered in a company's name, then we need registration documents for the company, things like that. So this is the basic list, but there may be other items added on, but it's really dependent on what comes out in the search. And then the last item would only be applicable to construction mortgages. So if you own your land free and clear and you're now borrowing to construct, we would require like estimates and approvals for the construction, or if you're doing major renovations to your home or something, we would then require estimates for that aspect of it. And the very last slide, so we're almost at the end, and I hope I have not bored you all. The very last slide really focuses on the benefits of financing your mortgage with CECU. I know it is a very, very competitive environment, and you turn on the television, you turn on the radio, you read the newspapers, and you see every financial institution coming at you advertising. And some use, I call them marketing gimmicks, things like, we're going to give you cash back, you're going to save this and save that. I will tell you that the commercial banks do not give anything free. So if they're giving you cash back, bet your bottom dollar, you're paying for it the next year when the interest rate goes up. But I want to just highlight some of the benefits with your credit union. And that the first benefit, and one of the biggest benefits, is the continued earning of a return on your down payment at the competitive rate. You will have savings set aside on your account when your mortgage is paid off. So if you're not able to save anything else during your mortgage, you have savings set aside at the end, and that is given back to you with dividend added on over the years once your mortgage is paid off. You get hands-on guidance, as I said, from the consultation straight to when the keys are handed to you in your hand. We hold your hand and we guide you through. And it's senior officers that you're dealing with. I do all the consultations, and very soon, Asha, our finance manager, is also going to be facilitating consultations. But we really give that personalized and convenient service, and we explain everything to you along the way so that there isn't any cause for worry or uncertainty or anything like that. We really make sure you understand everything that you're getting into. It is a one-stop shop. As I said, we do have the service providers on our panel so that you don't have to go around looking for people. We can put things in place for you. Our interest rates are competitive, and they are on the reducing balance, so that, and I mean, we check what our competitors do, and we do know it's competitive. Our rates are competitive. Always very happy to say that we don't have additional administrative fees or hidden costs. What you see is what you get. Exactly what is in that slide regarding the member costs and whatnot, that's it. That's the fees that you have. We do have flexible repayment terms, so that if you wanted to accelerate your mortgage, we do facilitate it. If you wanted to arrange lump sum payments annually, we do facilitate it. What we do is we actually build a schedule into your mortgage loan agreement, because there is a cap that we will allow in terms of the lump sum payments. So we limit you to one lump sum payment a year, and based on the value of your mortgage, it will be determined how much you will be allowed to pay down. But we do allow the acceleration of your mortgage. And of course, our legal fees are discounted as well. So these are some of the major benefits that you can get that you can get if you decide that you would like to finance your mortgage here at CECU. So I am now officially at the end of my presentation. And I hope that it's been really helpful. I hope that we've been able, or I've been able to educate you and shed some light on what we offer here at CECU. I do hope that any of you who have logged on and are interested in pursuing a mortgage, that you do set up a consultation with us and have a chat with us. Because I can tell you, I mean, over the years, it has happened so many times that 1 year after a member would go to the bank and take a mortgage, I get the call, Ms. Travelway, can I move my mortgage? Because the bank just sent up my interest rate by 1%. And, this is what the installment is now, because again, that aggressive marketing, they catch you. But, you know, come to your credit union first. Have a discussion with us before you make any of these big financial decisions, because we will try to help you. So I'm going to hand things back over to our moderator now, so we can open up the Q&A session.
Okay. Thank you, Kelly, for such an informative presentation. I'm sure our members has a lot of questions to ask. So at this point, we will be beginning our Q&A segment. A gentle reminder to our members that you can place your questions in the chat box, or please raise your hand to have your mic unmuted. So the first two questions that we are seeing relates to constructions of homes, right? The first question is from Nikisha Khan. Are there mortgages for the construction of homes?
Yes, we do mortgages for construction of homes, but it's only when the land, you have to look to own your land free and clear. So we don't do bridging construction, meaning that we lend you the money to purchase the land and then you can construct on it. We would only consider construction type mortgages if you own that land free and clear. So we hold the land as the value of the land as collateral together with your shares as collateral.
Okay, thank you for that. Second question is from Melissa Murray McCain. She wants to know, what about for construction? How does it work? Now, I guess, and that's kind of the same thing that you just said.
Yes.
I don't know if you want to reiterate a little bit more on it.
Well, the construction loans, it's basically what I just said. Essentially, it really is on a case by case basis, because we have to be able to see that the person owns the land free and clear. Again, we have to look at the value of the land. So obviously a valuation would be required to assess the value of that land. We would also have to take into consideration the cost of the structure that you want to put up. So the established, not the established, the estimates, sorry, the estimates for construction and all of that. So that's basically what I recommend for that one, is that maybe you should book a consultation for that one. If in fact you do own the land free and clear, maybe book a consultation with us, Melissa, so that we can look specifically, and also Nikisha, so that we can look specifically at your cases, because we would have to look at it on a case by case basis.
Okay, Kelly, thank you for that. We have a question for Mr. G1. Question, if one has the 20% saved, is the bridging loan still necessary?
Not, so you have the 20, right? Not necessarily. If you wanted to, well, we have to have obviously the 10% here on your shares minimum. So if you wanted to leave the 10% here on your shares and then take 10% that you have and pay it to the vendor, which means you're borrowing a bit less, that's fine. The most important thing is that you have the 10% here, and obviously we assess debt service ratio and ability to repay and all of those things. But yeah, if you have the 20% and you wanted to split it, you could. It just means that you may be borrowing, but borrowing slightly less.
Yes, that makes sense. We have a question from Esther. She says, you indicated that members have previously called asking if they can move their mortgage. What is the criteria?
Okay, so the first thing, and this is really where we put the members' interest first with this one, because we could say, yes, bring the mortgage across, you know, we want the business and all of that. But the first things we tell you is, how long have you had the mortgage? We ask you, I should say, not tell you, ask you, how long have you had the mortgage with the bank? Because if you've had a mortgage less than 5 years with any commercial bank and you are trying to move your mortgage, the commercial banks are going to penalize you with penalties. So we generally advise the members to check with the commercial bank first and inquire what are the penalties to move. And the reason we're saying that is because, remember, when you took the mortgage, you would have already gone through the legal fee cost. So you would have already done the valuation and paid for it. You would have already paid the legal fees, which is conveyancing and deed of mortgage and all of those things. Moving the mortgage across would mean that you may be incurring penalties with the commercial bank. And then if you're moving the mortgage across to us, we're going to need a valuation. And then a new deed of mortgage needs to be done. So there will be legal fees as well. So we don't deter the members, but we advise you've got to weigh the pros and cons there and the economics of it. If it works out better to move the mortgage here, then by all means, we can look at it once you have the 10% on your shares, because obviously it's going to be based on what is the balance of your mortgage at the bank, as well as what's the value of the property and all of that. And once you have the 10% here on shares, then we can look at moving it. But you have got to weigh the economics with moving that. So you've got to find out what the penalties are first.
Yes, agreed. We have a question from Ria. What is needed for self-employed persons whose income fluctuates?
Okay. So for self-employed persons, so the supporting documents become a good bit more for self-employed persons. And as you rightfully said in your question, the income fluctuates every month. So what we generally ask for is if you're self-employed, your business is registered, we want to see the registered documents. We want to see bank statements. We would probably ask for bank statements for the last year or two. We would want to see financials. If you keep some sort of financials, we would want to see things like invoices and receipts, and it's almost like an audit we do, matching back the revenue and seeing it coming through the bank statements. So things like that, because what we're assessing there is your ability to repay over that longer period of time. So the additional requirements, in addition to everything else that we listed in the checklist, would really be registration documents, 1 to 2 years bank statements, financials, specifically profit and loss, cash flow projections, and evidence of invoices, probably for the past year or two as well.
Okay, thank you for that. Can you tell our members what types of mortgages does CECU finance?
We do full purchase mortgages, meaning property. You see a property that you want to purchase, so a house, a townhouse, whatever it is. We also do, and it was asked here already, construction type mortgages where the member owns the land free and clear and is now looking to build. We also do mortgages for the purchase of land. So we do have members who are thinking about buying land as an investment. And we also do home equity loans. So if you already own your home and you're thinking about maybe major home renovations or something like that, your roof needs changing, that's not a small amount, that's a couple $100,000 there, and you own your home free and clear, we could look at the home equity loan. Sometimes there are home equity loans in terms of education for children. So those are all options.
Thank you, Kelly. What about HDC homes? Does CECU finance HDC homes?
So that's actually a question that's been coming up a lot recently. A few members have been calling and asking. And the short answer there is no, but I want to explain the reason why. Because we have been getting questions about HC land, HC property. Now, HC land and HC property is always owned by the government. What that means is that the government always has first lien, meaning they have the first hold on that land, on that property. And any financial institution who is coming in to give a mortgage then has to take second lien. So we go behind, we stand behind the government. And that's something that we don't do. So for HDC properties and land, a lot of the time it is HEC and TTMF that gives the financing for those. And it's really because of government having first lien and a financial institution having to take second lien. So no, we don't do those types of mortgages.
Okay, thanks. We have a question from MG1. Will CECU offer loans for homes valued above 4 million?
Once you meet the requirements, we would consider it. So requirements meaning you must have 10% of the amount that you wish to borrow free and clear on your shares. You must fall within the debt service ratio. So you've got to be gainfully employed. Your debt service ratio should not be for that value, your debt service ratio should not be more than 40%. So essentially 40% of your gross monthly income would represent an installment. So it would really be based on meeting the specific criteria.
Okay, noted. I know you mentioned it earlier in one of your slides, but just remind our members, how long does a typical mortgage take to close?
On average, it's about 90 days. Most mortgages, and that's the standard clause in the sale agreements. But we have had, and that's, let me backtrack there, and that's for purchase of property that is already constructed and built and all of that. It's generally 90 days. Sometimes there is an extension clause. We saw the extension clauses in effect a lot during COVID when everything was shut down, because there are two things that take a little while to obtain, and it's the WASA clearance, and sometimes the town and country approval takes almost a month to obtain. So if there are delays with WASA clearance and town and country approvals, sometimes a mortgage is extended by an additional 30 days, taking it to 120, but most of the time it's 90 days. With the mortgages for developments, that is a bit different because that's developments actually being constructed. So you would find that their closing periods may or may not, be longer than the 120 days.
Okay, Kelly. So could you just remind our members how CECU's interest rates are calculated on mortgages?
Sure. Our interest rates are calculated on the reducing balance. So what that means is that every installment that you make, part of it will go to principal and part of it will go to interest. And your interest every month is calculated on your outstanding principal balance. So that what this means is every month your principal is coming down and getting smaller. And therefore, every month your interest is getting a little smaller and a little smaller. So it's reducing balance. It's really called an amortized mortgage loan. It is very much practically the same thing that the commercial banks use as well.
Okay, thank you for that. We have a question that just came in from T. Joseph. What about properties that need immediate upgrades to be move-in ready? Example, purchase of property where the roof needs to be replaced.
So I just need some clarification with the question. So is it that you're asking about purchasing the property where repairs need to happen? So you're talking about taking a mortgage. Okay, so you're talking about taking a mortgage to purchase the property and also, for example, repair roof? Yes?
He typed in yes.
Okay, so that will be based on the valuation. Because essentially, when we are lending money, we have to have the collateral to back it. And generally we hold about 110% collateral, which is value of the property plus the 10% on your shares. So that if there is extra equity in the property, so for example, let's say the property is being sold, you want to purchase a property and it's $1 million. But when the valuation is done, the value of it is 1.2 million. So there's extra equity in there. Then we can consider lending for the repairs, but that would be really on a case by case basis. right? So, but it does come down to the valuation.
Great. We have a question from Akima Hernandez. What is the highest value SECU will provide a home equity loan for construction for land owners?
Okay, that's two different loans. So is it that, so you own the land, and this is just so that I can answer the question a little clearer. So is it that you own the land free and clear, meaning there is no mortgage on the land and your name is on the deed and everything, and you are now looking at constructing a home? Is that what you're asking about? Okay, right. So I can't really give you a figure in terms of highest value because it will be based on your ability to repay. So we will look at things like, how much do you have on your shares? What is the value of the land? Because we would have to get a valuation for the land. And then it will be down to, again, your most importantly, the ability to repay at that point. We would need to see what is the estimate for construction. And then based on that, we kind of have to work out, okay, what's the debt service ratio? So we have to take into consideration what's your household income, based on the estimate for construction, what is the figure you would be looking at, and then work out the debt service ratio there. So I can't give you a maximum value. It would be on a case by case basis, and it would be based on the individual's ability to repay.
Okay, thank you for that, Kelly. We have a question from Dwayne. If a home was valued by evaluator, do I have to get SECU valuator again to access the land? I'm thinking he
It,
wants to know. Yeah. Yeah,
okay,
sorry, go ahead.
so it depends on, so we have a panel, we have four evaluators, yes, on our panel. So on our panel, we have Brent Augustus, we've got Jay Farrell, we've got Raymond and Pear, and we've got Lyndon Scott. So if the evaluations were done by any of those companies and the evaluations are less than 3 months old, we will use the valuation. The reason being as well is, and this is, you'll hear a lot more about this in next week's session that I hope everybody logs on for, because that's all the legal, or the attorney will be talking there, and she will speak to this too. For stamp duty purposes, if stamp duty is applicable, the valuation has to be under, so it's between 3 and 6 months. So if you've done the valuation, I mean, even if the person isn't on the panel, we may still consider it. We would have to research the evaluator and make sure they are registered and all of that. But our four main evaluators, we kind of lean to them. But the valuation report has to be less than 3 months. If not, we would probably ask for another valuation to be done.
Okay, very informative. So we just have a little feedback from Mr. Douglas Clark. He says, very informative session. Thank you for hosting. So thank you for that feedback, Mr. Clark.
You're most welcome, Mr. Clark.
Okay, so one question, Kelly. Are lump sum payments allowed for mortgages?
Yes, we do allow one lump sum payment per year, and we do not allow more than 10% of the value of your mortgage at any one point in time. So what we actually do at the point of, yes, one per year, Dwayne, one lump sum payment per year. And I will explain why. Let me explain why one time. You've got to appreciate also there is a business model here. So if we're lending a very large sum for a mortgage and we're lending it for an extended period, then in terms of interest projection is also for a longer period. So we do recognize that members may want to pay lump sums, but we don't allow too much of that acceleration on the loan to come down too quickly, because that's also going to affect interest. So we allow one lump sum payment each year, no more than 10% of the outstanding balance. What we actually do is we build a schedule into the mortgage loan agreement. So we actually build it in. We say, okay, in the first year, this is what's allowed. Second year, this is what's allowed. And we kind of break it down like that. So it will be built into your mortgage agreement. And we do not allow any full repayment, as in paying off your whole mortgage within the first 5 years.
Okay, great. I see Dwayne is ready to have a consultation with you. He said
Okay,
need to have a
Dwayne, you
consultation.
can book that consultation. Send us an email with your name and
Yes,
contact number. And Adeline has just put the
put the
email
details
address
there for
there so
you.
you can book your consultation.
Very good. So we have a question from Maurice Mirage. Is that lump sum payment based on the initial mortgage value or based on the residual balance?
It's based on the residual balance. So as your mortgage balance comes down, so the 10% is based on the outstanding balance at that point in time. So if you borrow 1.5 this year and next year you're down to 1.3, the 10% is going to be based on the residual coming down.
Okay, he said, okay, thanks.
You're welcome.
What about early repayment of mortgage? Can that be done?
Yeah, I just mentioned it. What we do not allow any full repayment under 5 years. So after 5 years, if you want to pay off your mortgage, you win a lotto or something and you want to pay off your mortgage, we will okay it. But under 5 years, no.
Okay. Dwayne says, thank you, very informative.
You're welcome.
Okay, so again, we would like to extend to our members online. If you have any other questions, feel free to raise your hand or type it in the chat.
While we're waiting for any more questions, I just want to like demystify some of the I think it's really sometimes misconceptions. I call it just marketing gimmicks, and it's sometimes perceived incorrectly. So it's to bring some clarity to some of the marketing gimmicks that you see out there sometimes. So one of the biggest ones, and you see it very, very often, because I mean it really catches you if someone tells you, I'm gonna give you back money, you're gonna jump at it, right? That cashback, and I said it in my presentation. So the commercial banks, I don't know if you check or you look at, well, not that you look at the financials, but you must see it in the news reports, the kinds of profits the banks make. When you start to drill down in the financials and you look at it, so I'm a finance person, so I tend to look at those things. A lot of their money comes from the non-interest revenue, which means charges and all of that. Commercial banks don't give anything for free. So if at any point in time a commercial bank is giving you back money, you have to be slightly afraid of accepting it, because bet your bottom dollar it's going to come back at you. Generally, what happens, and I actually work this out for a member. We were having discussions here about our offering for a particular value is shopping around for a mortgage. And I encourage members, shop around, check with the banks. It's the biggest investment that you're going to make. So by all means, compare and find out what places have to offer. And he was saying, I checked this commercial bank and this is what they're offering. And look at what the installment is. And when I ran the amortization side by side, same interest rate, same mortgage value, same term. There was a whole $100,000 extra actually built in at the end of when you look at how much the person would have paid back after 20 years or so. It was an entire $100,000 extra that went in there somehow, where the bank would be coining that. And what happens is too that, so in every, and I'll be very transparent about this, in every mortgage agreement, there is always a clause about variable interest rate. So Dwayne has me laughing with it. Dwayne, book that consultation one time. um, Yeah, there's the variable interest rate clause. And what that clause is, it's a standard clause in all mortgage documents. And it basically gives the financial institution the authority to adjust your interest rate should you need to. And of course, the requirements to advise your customers and all of that. I will tell you, since CECU has started or restarted our mortgage portfolio back in 2013, we have never raised our interest rates. We've actually brought our interest rates down. But what the banks do is they enforce the variable interest rate clause. So 1 year after you take your mortgage with a commercial bank, and they don't really tell you. Sometimes they tell you, sometimes you don't. But just keep looking at your installment, and you're just going to see your installment is going to start going up and going up and going up. It's because it's an adjustment on the interest rate starting to take effect. That's how they're getting back the money that they would have given you up front when they tell you we're going to give you whatever percent of your mortgage back, so it'll help you with fees. They're actually going to be taking it back, building it back into your mortgage in the long run. So those are some of the marketing gimmicks that's out there. And as I said, it's eye catching. Who wouldn't be caught with you getting back money in hand? But just keep that in mind. When they give you something, they are going to take it back, and it's like you sign with them for life. Because then to leave the commercial banks and move your mortgage, it's penalties upon penalties. And to answer your question, Dwayne, yes, $700,000 mortgage does have it's a 5.5% interest rate. The reason we don't negotiate it a lot is because we don't have the additional fees. So the banks actually do a lot of negotiation because they add on the fees, especially the negotiation fee, which is a percentage of the mortgage, but we don't have any additional fees. So that's why we have the 3 tranches for the mortgages in terms of rates.
Okay, thank you for that, Kelly. Well, at this point, I'm not seeing any more questions in the chat. And I guess we could round things up right now. Thank you, Kelly, for facilitating today's session and helping our members understand the CECU's mortgage process. I'm certain that they have more clarity on how they can go about obtaining a mortgage. We getting feedback in the chat that it was quite helpful from Ria. So that's a good indication right there. Just a gentle reminder to our members, should you wish to book a consultation with Mrs. Troubley Hack, you can do so via the email address info@mysecu.com, and feel free to go to our website to learn more about our mortgage products. Please note that part 2 of our mortgage webinar series entitled Legal Guidance in Purchasing Your Property, it takes place next week, Wednesday, which is the 24th of May at 5 p.m. And it will be facilitated by one of our attorneys. So please register early, don't miss out. And the link for the seminar was also placed in the chat by Ms. Ganesh, and it's right there now. So you have no excuses, right? Okay, at this point, we have come to the end of today's seminar. Thank you for your attendance, and I do hope that this session has been informative and very helpful. I wish you all a good night and God bless.
Thank you. Good night, everybody.
Good night.